And welcome back to Kotak Cherry. Today we have a very special guest with us, Mr. Neelesh Dhamnaskar. He has been with Invesco for the past 10 years and has 15 years of experience as equity research and in fund management. So, hi Nilesh, glad to have you on board.
Yeah, hi Snehal. Thanks for having me here, and a warm welcome to all your clients.
Thanks, Nilesh. So, moving on, given that the current volatility in the market, what are some options, overseas investing options for diversifications in the market, Nilesh?
Yeah, sure. So, see, before getting into that, let me kind of explain why overseas diversification is important. See, what we have seen is generally investors prefer investing in the home country due to better understanding the companies listed and ease of investing in the same. Though over the last 10 years, while the BSE Sensex has given strong returns and certainly has done better than most other emerging markets, but during the same time frame, some of the developed country indices like S&P 500, the Nasdaq 100 index have also done very well. See, we believe that investors should continue to invest major portion of their equity portfolio in the Indian markets, and once that is done, allocate some portion to the overseas equity funds. See, what we believe is that depending on the risk appetite of the clients, we generally recommend that investors can allocate around 10 to 15% of their equity portion towards such overseas equity funds. Okay. And currently, if you ask me where we think that the overall risk reward is better, we believe that the US large cap growth as a category offers a decent risk reward at this juncture. And in terms of the avenues, I see there are various multiple avenues for investing in overseas markets. One, the simpler way to invest globally is to either look to by investing in passive funds, okay, which simply replicate in major indices, or invest in actively managed funds, which invest in overseas companies. So this is what I would say on this front. Yeah.
Nilesh. So that was quite insightful. So, as you had mentioned, what would be some of the benefits which domestic investors can look at while investing in these overseas markets?
Right. Yeah. A good question. So you see, so apart from few of the aspects which I just touched upon, see, there are, according to us, four key benefits of investing in the overseas markets. See, the first benefit is diversification beyond home country. See, investments in countries other than the home country can help to reduce the risk associated with the investments in a single country. See, for example, say for whatever reasons, due to a cyclical nature of GDP growth or due to exogenous reasons, if one's home country is going through a low growth phase and the domestic equity markets were to remain subdued, investing in other country indices which may be doing well at that point of time would improve the overall portfolio returns for the investor. So that we should keep in mind. See, the second important reason for investing overseas is that investing in overseas markets potentially enhances the portfolio performance, because simply put, different markets perform differently at different points of time. So if you were to look at the tables of top performing markets globally each year, you will notice that every year the first rank and the last rank countries or indices are different. Thus, by investing in the overseas equity markets, one can smoothen the return profile at an aggregate level. So this is a very important reason for investing in overseas equity markets. The third important reason is low correlation. See, given the low correlation, generally we have seen when we analyze data, we have seen that there's a low correlation between many country baskets. So so what it does is that it again creates a very favorable impact on the portfolio risk and return characteristics. Simply put, adding exposure to overseas fund improves portfolio performance and reduces the risk as measured by standard deviation. See, for example, just to give you this in context, see the correlation coefficient of daily INR based returns of Nasdaq 100 and BSE Sensex is very low. It's less than 0.13, 0.13 rather. So if the investor were to have a combination of BSE Sensex and Nasdaq 100 index in its portfolio, then the combined returns are somewhere in between. But more importantly, the standard deviation of the combined portfolio is much lower, which reduces the overall volatility of the portfolio, and it benefits the customers, the investors. And the last reason, important reason, is that it gives you an opportunity to invest in global companies as well as businesses which are not available in India for investment. See, whether we like it or not, most of the innovative companies, okay, which have been doing well over the last few years, are not listed in India. See, like if I were to give you examples, companies like Apple, Alphabet, which is a parent of Google, Microsoft, then Meta Platforms, which was earlier named Facebook, okay, which are all globally dominant companies, and whose products and services are used extensively, not just throughout the world, but also in India. But since they are not listed in India, the only way to take exposure to these companies is by investing overseas. So I would say these are the four key main reasons for investing in overseas equity markets. Yeah.
That was very well put. So, as you mentioned that there are a lot of global innovative companies available for investment. So, could you throw some light on avenues available through which an Indian investor can invest in these companies?
Yeah, sure. So I touched upon that aspect in the initial address. So as I told you, there are a lot of passive and and actively managed overseas funds which the investors can take exposure to. So maybe if I were to talk about one of the most prominent indices, which is a very which many people invest in globally across the world, is the Nasdaq 100 index. So see, if I were to like talk about, or maybe rather before that, if I were to talk about the last decade, I mean, you see, the last decade has been actually that for innovative companies, okay, companies which have really transformed the way of doing business, and thereby they have created immense value for themselves as well as their shareholders. See companies like, again, Amazon, Alphabet, Facebook, Microsoft, Tesla, see, all have been at the forefront of innovation and have created extremely transformative products and services which are used extensively by the customers around the world. See, resultantly, some of these companies have become very massive entities. I mean, their revenues have gone up substantially over the years and have created wealth which has surpassed even the GDP of many countries. See, for example, just to give you a sense, Apple has a market cap of almost $2.7 trillion, which is more than the GDP of Italy. So that is how big they have become. Okay. But again, the case in point being, most of these wealth creators of the last decade are based out of US, which even now remains the very nerve center of innovation. Okay. And most of these companies are listed overseas, especially in some in indices like in exchanges like Nasdaq. Okay. So for say Indian investors who want to kind of take exposure to such innovative companies, the simplest way is to invest in passive funds, okay, which in turn invest in the indices which comprise of these innovative companies. The Nasdaq 100 index is basically is nothing but it gives you exposure to the 100 largest US and international non-financial companies listed on Nasdaq stock exchange based on their market capitalization. Just to give you an overview of the index, it's more than just an index. It's kind of from a simplicity of understanding. See, it is home to the world's most influential and innovative companies. Say Apple, Amazon, Alphabet, Tesla, Microsoft are some of the world's most successful and innovative companies. See, Nasdaq 100, and many people are not aware, Nasdaq 100 is not just limited to technology sector alone. Even consumer companies like Comcast or Starbucks, Costco, and others, which have been innovative in their own spaces, okay, are also part of this index. See, and it's no surprise to see that Nasdaq 100 companies being consistently ranked as top innovators, and these companies are, I would say, transforming the way the world is the world and the present, transforming the way the world is doing business with, and this as a segment kind of presents a very strong investment opportunity. Okay. Just to give you a sense of the constituents, see, the 7 of the top 10 largest market capitalized companies in the world are part of this index. Okay, so it comprises of those kind of companies. And see, the main unique feature of this index is that majority of the constituent companies are amongst the most innovative companies in the world, with very high R&D spends in disruptive technologies. See, these companies have been growing at a much higher pace than most other regular companies and have very strong fundamentals. See, so NASDAQ 100 companies have strong brand equity, very in terms of the patent filings also, they are at the forefront, and they have strong economies of scale and a decent degree of pricing power, which helps them to create value at large. Historically, if one were to see, the NASDAQ 100 index has outperformed other leading US indices due to its ability to provide access to this large cap growth oriented companies which are at the forefront of innovation.
Thanks a lot, Nilesh. That was very helpful, and I'm sure the viewers would have found it quite insightful as well. So, viewers, stay tuned. We will be coming up with more such videos with fund managers. Please like, share, and subscribe to our YouTube channel.